And welcome to episode number 16 of The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons. And today we're going to do something I've done a bunch of over the years, and that's providing a quarterly apartment market update. Here we are at the start of 2025, and that means we have fresh data on December and on Q4. So all data junkies love this time each quarter because it means we get fresh data. So I'm going to be giving you the latest on what we saw in the data for December and in Q4 for the U.S. apartment market, highlight some regional trends as well, what was surprising, what was not surprising, upside, downside, all that good stuff. And later in today's podcast, I'll be bringing in Greg Willett, with head of IPA research at head of research at Institutional Property Advisors, IPA, and my old boss. So we used to do a bunch of these together over the years, but since we've not been working together for a couple, 2-3 years now, it'll be the first time we've done a webcast or a podcast together in at least a couple of years. So I'm excited to bring back Greg for a conversation on the apartment market and the outlook. We talk a little about what surprised us in these numbers, and most of the surprise is honestly in the upside, because these numbers are I think a good bit better than what was expected going in to 2024, at least on the fundamental side. So we'll get into that, and I'll talk a little on the capital markets as well. Before we do that, I'll be giving you my rundown on some of the data we saw in those Q4 and December numbers, and we'll start that in a moment. But first, a big shout out to our sponsor for this episode, Madera Residential. All right, so here's the numbers. Let's get into it. We got some charts. If you can see the chart on the screen, great. If not, no worries. I'll talk you through it. But this first one, I think, is really the biggest surprise. There's not a lot of surprise when you can track data month to month and quarter to quarter, but occasionally you do get a real surprise, and that's this, where we see more absorption than supply in 2024. I don't think anybody really expected to see that. I mean, I was bullish on demand, but not that bullish. So everybody expected to see a lot of supply, obviously. Peak year for deliveries, nearly 600,000 units completed, but more demand than supply. Well, RealPage shows 667,000 units absorbed on net in 2024. That is a massive number that's just a little bit shy of the all-time peak set in 2021, just a few years ago. Now, I was pretty bullish on demand going into 2024. Like I mentioned, you go back and check the tape, but I wasn't that bullish. I thought we'd see moderately more supply than demand. So this absorption number, honestly, it's a bit tough to digest. But even if we quibble with the exact number, you could debate, data sources and methodologies. However you want to, whatever that exact number is, it's clear we did see a lot of demand in 2024. And you can't just credit a lack of home purchases, because while that boosted retention and fewer move-outs to home purchase, it doesn't explain the fact that we have 667,000 net new apartment renters. So clearly there's a lot of net demand out there, a lot of new demand out there, and clearly this big wave of new apartment supply is unleashing a lot of pent-up demand. And to that point, not surprisingly, we're seeing that demand is going where supply is going. That starts with Texas. The top 3 markets for net absorption in 2024 were all in Texas: Dallas, Houston, and Austin. Now here's something else that's interesting. Let's look at the biggest gaps between demand and supply, or where did demand exceed supply by the greatest margins. And those two markets that led by a mile were Washington, D.C. and Houston. And those happen to be the 2 markets that Camden, a publicly traded apartment REIT, mentioned as top performers in their last earnings call. So, and by the way, a third was Las Vegas. That's a market that took a hit early, or one of the earliest markets to take a hit at the beginning of this cycle, but seems to be improving now at a pretty solid clip. So those 3 really stood out, with demand exceeding supply by 4,000 to 8,000 units in 2024. But there are a bunch more clustered at 2,000 to 3,000. And some other high supply markets that saw more absorption than supply in 2024 include Phoenix, Jacksonville, Seattle, and Dallas, all 1,000 plus units more absorption than supply. On the other end of the spectrum, which market had the biggest gap in terms of more supply than demand? Well, this is going to surprise nobody. It is Austin. And it's a big gap, but not a crushing one at nearly 1,800 units. But overall, great demand numbers. I'm going to dive more into that with Greg in today's interview. So with all that demand, occupancy held surprisingly steady in 2024, ended the year at 94.8%, up a bit year over year, and now back around the long-term average. And that's pretty remarkable given this historic supply wave that we're in the middle of. Now, I should mention this is only for stabilized apartments, so it does exclude those recently built properties that are still in active lease-up. So we can still see occupancy come down maybe a little bit as those properties stabilize, or maybe not. but still a remarkable sign that occupancy rates among the existing marketplace have not been dinged more given all the new competition in the market. And certainly, too, we see the impact of operators prioritizing occupancy and retention over rents. I tell people all the time, everybody knows this, except for those outside the industry, was vacant units equals zero revenue. So occupancy has been the priority. And that's a theme we've heard about again and again now across the industry for a couple of years. And by the way, these numbers on occupancy, as well as the prioritization of occupancy, really aligns with what we've heard from the publicly traded REITs as well. And so for properties that are sitting around 95+%, which is essentially full, that potentially positions those properties to see rent growth rebound faster as supply starts to dwindle. Of course, the timing of that's going to depend not only on the market, but on individual submarkets and neighborhoods. Now, speaking of rents, if you squint really closely and zoom in a little bit, you'll see apartment rent growth inched up to an 18-month high at just 0.47%. So perhaps more importantly, though, is it does mark 3 straight months of ever so slight momentum improvement. And so it's still basically flat where it's been for about 18 months, but it's getting ever so slightly a little better for apartment operators out there. And also, by the way, just as a quick aside, I think it's interesting. We're now more than 2 years past the era of peak double-digit rent growth. So it's kind of wild to think about it. It was that long ago. I guess that long or that recent, depending on how you look at it. But certainly for apartment owners and investors, those days feel like the distant past at this point. Rent growth, again, it's still pretty flat. But I think if you're glass half full and you're looking for kind of a sign, maybe some early momentum that the rents are starting to turn a corner a little bit, you like to see what we're seeing here in terms of a little bit of improved momentum. But of course, the real test is going to be in the spring when the leasing season starts. Among individual metros, Detroit still leads the country among large markets, 4.1% year-over-year rent growth. That's effective asking rent growth with the concession. I'm sure no one other than Detroit investors would have predicted that a year ago. And I posted this on back to the month ago when this first happened in Detroit at the top of the leaderboard, posted on Twitter /X and LinkedIn. And I said, who had Detroit on top of their bingo card for national leader of rent growth? And a couple people said, oh, I did. And of course, they're all Detroit investors. So well done. But I think for most people who weren't involved with Detroit, they certainly would not have predicted that. Other notables above 3% include Kansas City, Chicago, DC, Richmond, Milwaukee, and San Jose. Still a strong story across the Midwest and Mid-Atlantic. They're definitely having their moment for sure, and a lot less supply there, which of course is the big tailwind, having less supply to wrestle with, as well as solid demand. And then on the West Coast, a solid rebound might be occurring in San Jose at Silicon Valley. More tech companies are bringing employees back to the office, and that might be having a little bit of a positive impact on rents. We'll see how that plays out. On the flip side, guess which market had the biggest rent cut? Okay, you probably don't think very long on that one. It was Austin. Rents down 7.4%. But again, following the national pattern, the momentum there did improve ever so slightly in December. In other words, the rent cuts were moderated ever so slightly. So, take that with a grain of salt for what it is. It does appear maybe the worst is behind it. And rents will probably still be falling for a while. The depth of rent cuts might be moderating. The only other metros to cut rents more than 4% were San Antonio, Phoenix, and Atlanta. One to watch, though, is Denver. That was a higher supplied market that's really held up surprisingly well. I shouldn't say surprisingly, just solidly well for a while compared to its peers. But counter the national trend, Denver did lose some momentum in Q4. And so rents there fell 3.5%. And I believe that one was fairly flat for a while. And then these last few months, we've seen some lost momentum there. And it is, again, a higher supplied market that had been holding up for a while, but it's now starting to cut rents. And a quick mention on affordability, the national rent income ratio for new lease signers and market rate professionally managed apartments went down in 2024 from 23.2% to 22.6%. So that's certainly a positive tailwind around affordability. And again, that's just for new lease signers and market rate apartments. So I've talked about this a lot previously. So if you're new to this, definitely need to bifurcate between those who live in professionally managed market rate apartments and those who do not. But those signing new leases in this segment tend to be spending a relatively low share of income on rent. All right, so construction's been the big factors. Let's talk about construction starts. Still falling, no surprise, Apartment starts are a 12-year low according to RealPage or a 10-year low according to the census. Either way, they're way down and not showing any sign of finding new momentum yet. So what's left when looking at what's under construction still? Now that we just delivered 600,000 units and had somewhere in the low to mid 200,000 range of starts in 2024, well, that leaves us with 653,000 units under construction. That's still a pretty significant number. It's about equal to where we were prior to COVID, which was already elevated compared to historical norms. So it's a big number, but it's nowhere near the peaks of 1.1 million that we saw a couple of years ago. And so we're coming off that cliff pretty quickly. Now, in terms of deliveries and supply, much of that existing construction total is going to complete here in 2025, about 470,000 units scheduled to complete this year. That's still a big number by historic standards, but it'll be pretty front loaded to the first half of the year. And then we see, pretty much everybody at this point is forecasting a pretty sharp decline or a very sharp decline in completions by 2026. RealPage shows 264,000 units completing in 2026, slightly less in 27 and 28. Everybody likes to ask, how realistic is that? Is that a real forecast? Well, I tell people all the time, supply is the easiest thing to forecast, relatively speaking, because it's just, starts push forward. We know there's been fewer starts. And so I've talked a lot about these factors, other podcasts. I'm not going to drone on and on about that again today. But, just briefly, I mentioned I'm pretty confident that 26 and 27 are going to be quite restrained in terms of total supply. I could certainly see more than what the current forecast show for 28 and 29. But even by then, it's difficult to see a scenario where supply levels come anywhere near where they are today. Now, let's talk briefly about the capital market side, looking at apartment sales activity. We're still waiting the December numbers, but I've updated the data from MSCI Real Capital Analytics through November. And this is actually refreshed data since the last time I shared this on this podcast. And it shows a couple of things here. If you're looking at dollar volume, which most of us do, we're up a tick from 2023, a little more volume this year, in 24 than 2023 when you look at a trailing 12-month number through November. But if you're looking at total properties traded, we're actually at the lowest level since 2011, which is pretty wild. So I'll talk with Greg Willett later today about his thoughts and the house thoughts at IPA about where that trend might go. And if you missed last week's podcast, I also talked to Justin Wheeler, the CEO of Berkadia, about the same trend. So check that one out if you missed it. All right, now let's talk about rental housing trivia. All right, so today's trivia question is, what was the first, or what is the first and actually only major high-supplied Sunbelt market where rents went negative in this cycle to now see rent growth return to positive territory? All right, so only one market has done this so far that went negative and now is positive with a lot of supply. So Miami is not an option because Miami was still slightly positive, but it didn't actually go negative. And so the choices here are Orlando, Nashville, Raleigh, and Tampa. So I'm narrowing down for you. It's in the Southeast. Which one went negative and is now ever so slightly positive on rents again? And if you've read my LinkedIn recently or as of this week, then you may know the answer to that one. Next up in the news. All right, 3 headlines to review this week, and a couple of them from the Wall Street Journal. This first one, I alluded to this one in last week's podcast a little bit, talking about the 25 outlook. It says, when fewer Americans are buying homes, these companies suffer. Americans aren't buying as much paint, flooring, or home decor. We only need so many couches. So, this is why I think every rental housing investor should be cheering for a healthy, strong for-sale housing market. The downstream impact of home buying is massive. Rising tide boosts all ships. A strong year for home buyers almost always equals a strong year for rental investors too, in terms of rental demand and rent growth. When you think about the best years for rent growth, including 21 and early 2022, well, we saw a lot of home sales in that period of time as well. And the article in the Wall Street Journal talks about how some of the companies that service home buyers, and in terms of home retailers, I should say, are closing up or downsizing. And that impacts the broader economy, which in turn impacts, household formation. So I mentioned this in the last podcast in 2025 predictions. I do think it's a long-term headwind because if it's sustained, we see slow home sales sustained. That equals slower economic growth and slower household formation. And again, I mentioned this too. In 2024, it's supposed to be the year of SFR. We saw slightly less SFR rent growth, and we saw decreased SFR leasing traffic despite fewer people buying homes. Now, obviously, the big discount to rent versus buy is a countering tailwind. So I'm not saying that's going to fall off the cliff by any means. This is not a doomsday prediction at all. But I don't think that rental demand can be sustained in these levels that we've seen in the apartment side very long. If home sales remain as low as they are, I think it just caps the growth. And I would reemphasize that everybody should be cheering for more home sales in 2025. Yeah, you'll lose more renters to home purchase, but that's okay because typically when homes are selling, you're going to backfill those units faster and at higher rents than you would otherwise. So we'll see how that one plays out. Again, please don't misunderstand it as a doomsday forecast, but I do think it's a cap on growth. The next headline also comes to the Wall Street Journal. It says, Wall Street landlords loved these DC suburbs. Rent control ended that. Montgomery and Prince George's counties limit rent increases to the lower of either 6% or 3% plus the inflation rate. So let me reload from this article here. It says, in July, Montgomery County and Prince George's County, by the way, these are the two big suburban DC counties just bordering Washington, D.C. We're bordering the district. So they really are more D.C. than they are Baltimore. So they limit okay. So because the new laws restrict rent increases, not just in apartments where tenants are living, but also on vacant units, meaning it's vacancy control, they are considered among the strictest in the country. Continuing to read from the article here, it says multifamily transaction volume in both counties was down 13% in the first 3 quarters of 2024 compared to the same period in 2023, according to MSCI Real Assets. All right, so I wouldn't read too much into the sales numbers for 24 versus 23. I mentioned nationally it's actually up slightly in terms of dollar volumes. In these two counties, it's down 13%. So that's a big number, but I don't think that's really beginning to even scratch the surface because these numbers are low to begin with. Bottom line, it's not surprising to see rent control backfire again. And the impact is going to be a lot greater than 13%. And over time, we're going to see that the negative impact on renters too, in the form of reduced supply totals, but also reduced quality of the supply in terms of reduced maintenance. I mean, there is a petition to get exception system, but there's no examples of that working out well. So don't just take my word for it, by the way. I've talked a lot about this previously, so I'm not going to drone on about it. But for those curious to study this more, I plug this all the time. There's a great episode of the Freakonomics podcast that breaks down why rent control backfires and the very people it's intended to protect. Just Google Freakonomics and rent control. And as an aside, it sure would be nice to see more media articles quoting unaffiliated academic economists and researchers on this topic rather than just quote investors as the lone opponents. Of course, investors oppose rent control. That's not a surprise. But what do impartial experts really think? Rent control is one of those things that just sounds good until you take the time to study its unintended consequences. The next headline comes from Reuters. Bill Ackman expects Trump to privatize Fannie Mae and Freddie Mac. So Bill Ackman tweeted and made headlines. He said, we have owned Fannie Mae and Freddie Mac common stock for more than a decade. Today, they trade at or around our average cost. As such, they have not been great investments to date. What makes them particularly interesting today versus any other time in history is that there is a credible path for their removal from conservatorship in the relative short term, that is, in the next 2 years. During Trump's first term, they took steps to do. I'm just going to summarize this a little more quickly here. They took steps toward this outcome, ran out of time. And I expect in the second Trump administration, Trump and his team will get this job done. So obviously, this is a hot topic throughout the industry in multifamily, but obviously more so on the single family side. So I don't know if it's going to happen or not. I think you can make a case that it will. But it's also, as we saw from the first Trump administration, it's hard to do. We talked about this a little bit on Willie Walker's podcast when I joined him a couple of months ago as well. And he mentioned this as well. It's a scenario, but it's hard to do. For multifamily, I think the upside would be obviously removing regulatory scope creep, like we saw in the COVID era and the period since then. There's a lot of work behind the scenes in these last few years to try to install various regulations, including potential rent controls through properties that are using Fannie Mae or Freddie Mac debt. Much that didn't happen. We still saw kind of the first steps toward it happening. And so that foundation's been laid. And then the downside, might be slightly higher debt costs, perhaps less favorable terms for niche categories like rural housing. So, again, we'll see how this plays out. It's going to certainly be a big topic as President Trump returns to office. Now let's turn to rental housing trivia. And the question today was, what was the first major high-supply Sunbelt market where rents went negative in the cycle to see rent growth return to positive territory? And so your choices were Orlando, Nashville, Raleigh, and Tampa. And the answer is Tampa, Florida. All right. So rents are just ever so slightly positive, but they have bounced back. And I think we're going to see more of these higher supplied Sunbelt markets join Tampa in that category here in 2025. All right. So with that, I'm going to talk more about these recap 2024 topics and outlook for 2025 from U.S. multifamily with Greg Willett in today's interview. Greg is the first vice president and national director of research for Institutional Property Advisors, a division of Marcus and Millichap. He's also the man who got me into the rental housing research business back with MPF Research in 2009. Like, as I mentioned earlier, we've done many webcasts and podcasts together over the years, but it's been a couple of years since we've done anything like this together. So I'm thrilled to welcome my friend and former boss, Greg Willett, into the studio. All right, now we enter the interview portion of today's podcast, and I am thrilled and honored to welcome in my former boss and a guy who taught me a lot about the industry many years ago, Greg Willett, now with IPA, Marcus and Millichap. So thanks for being here.
Thank you very much for inviting me to join you.
So, we're going to be talking a lot about the outlook, state of the market, whatnot, and that's something that you and I have done together for, golly, it's crazy to think it's been 15 plus 16 years, something like that. So I thought we'd first, though, reflect on how much better we have it now as researchers and analysts. I'll just tell you a quick, I don't know if you remember this, Greg, but my first assignment working for you back when it was MPF Research, I had joined in March of 2009. My first assignment was to write the fourth quarter 2008 Chicago apartment market report. And this was March. It went out in April. So I thought we could just briefly reflect on how much faster and better data is. We were talking about the 2025 outlook, and we already have data on 2024.
Yeah, it's amazing that we're recording the first week in January, and we have at least a rough version of year-end numbers already. And the amount of product that gets tracked in some of these third-party data sources is huge compared to what we used to see before. So you can do a lot more slicing and dicing, and it's just better data, and it turns almost in real time. And that's quite a difference when what's happening with government data, which is getting worse and worse all the time from my perspective. I will say the government's doing the best they can with the resources they have, but they don't have the resources that some of the private companies have at this point.
Yeah, especially in inflection points. I mean, just to briefly talk about that a little bit, like obviously starts and completions data from the census gets a lot of focus, but when that started to really change in 22 and early part of 23, we in the private sector, and it wasn't just, it's all the data providers. Right. They're all showing the same thing. And it's like, well, the census is showing this. And it was just lagged from what was happening. And to your point, though, there's a lot of good, smart people over there at the census and the Bureau of Labor Statistics, but they're just so underfunded and under-resourced.
So I will say, as we're bragging on the data, I will point out that it's evolving further, and now web scraping is becoming a bigger portion of the data. And I do sort of wonder what's going to happen with that. And are we going to fully understand what's happening at the bottom portion of the marketplace, that Class C sort of product? Because that sort of product is not really marketed or leased online. So we're going to, I think, be kind of wondering what's happening in those lower end communities.
Yeah, especially that non-professionally managed segment where you still have folks who are putting out the for rent signs and advertising on Facebook Marketplace, things like that. I mean, those are
the people who live in that sort of product really do move within that given neighborhood. And so as corny as it might sound, the balloons on the sign are actually an effective marketing for that sort of product.
Yeah, absolutely. All right, so let's get into, I appreciate those watching to allow us to commiserate on the evolution of data here. But let's talk about 2024. So we just got some of that data started to come in from the different vendors. Let's talk about the biggest surprises and forecasting misses for 2024. And I'll give one to start here. And for me, and I've talked about this previously, I think the biggest one was these resident retention numbers. I really thought we were going to see, and it went up in COVID, and then the peak inflation period, we had low vacancy. 2023 retention numbers started to come down again as supply went up. And so I thought, hey, sure, like these retention numbers are going to keep coming down. Peak supply hitting the market. Renters have more options, they can, easily move around for a better deal. And that didn't happen. And there's a lot of reasons for that. But what were some of the biggest surprises or forecasting misses for you?
So a couple things jumped to mind immediately. First is really just the upside surprise was the volume of renter demand that was seen last year. And you had said it was going to be strong. I had said it was going to be strong. I think everybody was expecting it to be pretty substantial, but it was more robust than even the most aggressive people were forecasting. And I think the biggest factor there was that the expansion of the economy held up better than was anticipated, but also it was the nature of the jobs we added. And particularly, we did a good job of adding jobs in those medium to low paying categories, which would feed into rental demand more so than for sale product demand. So again, biggest upside surprise was the demand numbers. The other thing that really occurs to me is the trade volume didn't bounce back to the degree that was expected. And that shows up in a couple of ways. We had this wave of loan maturities that were hitting, and man, we did a great job on that extend and pretend route. And so that really didn't end up resulting in meaningful distress and some forced sales that it seemed like were going to happen. I'll point out that can't continue forever. At some point, probably pretty soon, we're going to see a little bit more of that activity. And then in terms of institutional capital coming back into the market and stimulating some investment activity, that happens to some degree in the last half of the year, but not anywhere close to what I think had been anticipated coming into the year. And so, 2024 in a lot of ways was just a wait and see sort of year, and everybody held off looking for the next signal of what's coming.
Yeah, and I think that's a good way to characterize it. And certainly the lack of sales is a miss for me as well. And I think most of us didn't expect some, massive resurgence, but we did expect to see more of a pickup than we did. So let's talk more about that in a minute in terms of 2025. So let's talk more about markets though. And Greg, for you and me, we're in that group where I think anytime we're at a conference, everybody always wants to ask us, hey, what markets do you like? What markets do you not like? And they're hard questions to answer because there's obviously a lot of variables to it. But let's talk at a high level though. What are some markets that you missed on in terms of the forecast, markets that, upside or downside? And I'll give you a couple first. Miami is probably a market that I generally just struggle with. It's a tough market to track. Obviously, the job, you and I have talked about this in the years past. I mean, things like jobs and incomes just don't meet as much in a market that's so dependent on, foreign money coming in, retirement money, all these other factors that don't really show up in traditional economic variables. And that market's actually held up. It's got a lot of supply. It's got shadow condo supply as well. And the rents never really got negative. It's held up fairly solidly, despite some census data. Who knows how good it is, showing slowed migration and job growth in that market. Another surprise I'll give you, also kind of on the upside, is that Phoenix, that was really the first market that showed signs of softening. I remember a couple of years ago writing an article about, or a LinkedIn post, what's going on in Phoenix, and it was really cratering. And it got bad there, and then it really didn't get worse. And now it's starting to it's still negative, but it's kind of getting a little better and didn't really get hit quite as hard as I thought it would. How about you? What were some surprises?
Certainly the biggest outperformer from my perspective was Seattle. As we were coming into 2024, the increase in the delivery number was huge. I want to say it was 120% or so over the 2023 number. And at the same time as that was happening, the urban core in Seattle was clearly struggling. So I felt like this one was headed for some trouble. But in fact, occupancy held pretty stable during the course of the year. That product that got delivered, including a large block of product in those urban neighborhoods, leased up pretty well. And by the time we got to the end of the year, tiny rent growth, but it was actually a positive number. So I thought that was a very vulnerable market that ended up holding up pretty well. If I flip that, probably the biggest disappointment from my perspective was Atlanta. And Atlanta faced the same supply challenges that a lot of the Sunbelt markets did. But it wasn't just a supply story in Atlanta. There was some weakness in demand and some weakness in just general operations. I mean, as you talk to people, operators about renter fraud, Atlanta's the first market that comes up in that discussion every time.
Delinquency.
So, and you're just having a hard time cleaning up the rent roll, where you've had some people who have been in units that they've not been paying for a while and yet can't get them out. So some challenges in that one that maybe were a little bit more than I was expecting coming into the year.
Yeah, so let's talk about those two real quick. So Atlanta is an interesting one because I think it has been a challenge for nearly everybody. And I think part of it is Atlanta obviously has a lot more competition for jobs in the Southeast now and in migration. But I also wonder if Atlanta is becoming more of a market where it's, every city's like this to some degree, but Atlanta is maybe more like a Houston, where it's so neighborhood specific in terms of what is really investable at this point. Because there's some places that I think would be really tough sledding that actually did pretty well in the period everybody did well, but I think there's going to be more haves and have-nots going forward.
I think it's an interesting comparison, and I've always said that if I'm making investment decisions based on the metro numbers, I would never go to Houston. But in fact, there are neighborhoods and product segments where Houston is a great market.
Absolutely.
And I would put Atlanta is moving into that same sort of category now, where it makes sense to be there selectively. But there are places that are going to struggle.
I still like that 400 corridor going north. But there's a lot of spots we won't name names. There's some spots I'd probably redline.
There.
And Seattle, one thing I'll point out about Seattle, I think I agree it's an upside, but that is one of the few markets that's actually hasn't yet peaked on supply. And so I am curious how that one is going to play out. I think you're right. It's going to be pretty strong, but I wonder if we'll see more difference between the eastern suburbs, which have been pretty resilient, versus the urban core.
Again, I think there can be some weakness in the urban core, but so far so good from my perspective.
And obviously the return to work for Amazon and others has been a good factor there for some of the urban core apartment owners. Now let's talk about one thing that you and I have. I'll give us a little bit of credit here, Greg. I don't know if you remember. I'm sure you do remember this. Years ago, we were at a conference and we had the dreaded luncheon session where you have to talk about stuff while people are trying to eat and socialize. You have the clanging of dishes. And I always hate that time slot when you get that. But you and I were doing a session and we had a whole segment around why rental housing investors, SFR and apartment owners, should be cheering for a healthy for-sale housing market. And so, one thing that I was carrying that on, we had, I mean, this was way before COVID, like mid 2010s. One of the things I saw early on, and I'm sure you thought about as well, is that when everyone was talking about, hey, no one's buying homes anymore, this is a good thing for rental housing demand. It's not quite that simple, right? And I think that I'll give you one more story here. I remember a headline in the Wall Street Journal saying that SFR was going to have the best of times because of this dynamic. And in fact, SFR rent growth did not actually reaccelerate. It actually came down a little bit. So, so I mean, I think going forward, that could actually be a little bit of a risk to long-term apartment demand and SFR demand, just because if the home sale market's weak, that's going to probably impact the economy at some point.
It's true that what's happening in the for sale housing market is a good indicator of just what's happening to the economy overall. And whenever you have a growing for sale market, it's not just people buying the homes. It's, hey, then you furnish it and you do all these other things. I mean, it really contributes to overall growth. So generally, I think that's true. I will point out that I think the math is starting to change enough that that's not as true as it was historically. And so by our calculations now, if you buy the median price home in the US at going mortgage rates, et cetera, you're going to spend about $3,000 a month on your home payment. And typical rent now across the US is $1,800 or so. So, off the top of my head, that math is what, like a 60% premium or so? I mean, that's a much bigger premium to buy than it has been historically. And so I think that if that continues, I mean, we had that for a couple of years. If that continues, we are going to change that relationship between renting and buying and the overall home ownership rate. I mean, it's moved a tiny bit now, but not much. But I think we have to watch this moving ahead. And
I certainly agree with you. I don't think it's a doomsday factor for rental housing. I think we're going to see a larger share of the household formation going into rentals versus for sale for this reason, barring some government intervention that makes homeownership easier again. But it just seems to me like that the total pie for household formation and job growth is going to slow, just because of the downstream effect of home buying. People, go shopping more and do all those other things. There's various studies on this. So again, not a terrible scenario because of the factor you mentioned. That gap is important, but I still think, to our conversation a few years back, is that we should be cheering for a better home sale market. That gap's probably going to be there regardless in terms of the price gap, but we need to see, I think, at least a moderately stronger for sale housing market to see a better rent growth outlook. So we'll see. All right, so that tees us up to 2025, Greg. So how do you see high level 2025 playing out for multifamily?
A couple of thoughts there. I characterize 2024 as the wait and see year. Looking at that same sort of perspective, 2025 then to me is the get off the sidelines year. I mean, you got to start doing something. You want to get some of that capital deployed, whatever your investment strategy is, you need to go and start making that happen. If you're in development, I mean, with that starts have slowed down drastically. You're going to try and get something going that's going to be delivering in that 26, 27 period where we know that deliveries will be slowing down. On the operations side, I mean, you've been struggling. You've had some downward pressure, partly because of the new supply. So you need to start getting ready for that. We're going to be in a transition year in 2025, and that downward pressure that's come from new supply and capital markets disruption. So we're not going to have so much downward pressure, but at the same time, the uplift probably doesn't show up in a big way until 26, 27. So you're positioning to take advantage of what's coming ahead.
Yeah, I agree. I think the transition year is a good term for it. And, I think everyone seems to be in this wait and see mode. And I shared this recently, but there's a great survey by John Burns and CRE Daily showing that, the vast majority of investors want to be net buyers for multifamily. But in the same survey, the same respondents say that capital availability is far below typical. And so everybody wants to buy, but getting to the capital is still very challenging. And so it seems to me, for the reasons you mentioned, and I don't want to sound too much like a fundraiser here. I think this is just fundamentals. The dynamics of it are such that this transition year with supply coming down, rents are showing us some upward momentum again. We have 3 straight months where year-over-year rent growth has improved modestly, I should say. It's at least trending in the right direction, and starts coming down and whatnot. There's some risk of, if you're in wait and see mode too long, you're just seeing things, the market recover, and then you're all waiting for everybody's waiting for these green lights to all emerge. And at that point, you're probably going to see a much tighter market where you end up paying more and losing some of the kind of initial rebound effect that appears to be kind of in the short-term outlook. So, we'll see, obviously, but it certainly seems, I agree with, of course, your outlook there.
So yeah, it certainly does feel like we've moved past the turning point at the top of the market.
Yeah.
We can discuss further that there are segments of the market that's like, I'm still questioning exactly what's going to happen, but I do think the world gets better, and you're moving toward positioning for what comes in 26 and 27.
Yeah, let's jump to that. So let's talk about that. Tees up well the values conversation. So I think you and I both agree that that you look at newer vintage, well-located assets. Everybody wants to buy this stuff. It's not a secret. The REITs, institutions, private capital, small, big. Everybody likes this stuff. You're talking about stuff that doesn't need a lot of capex improvement dollars. It's got good demographics, lower rent-income ratios. All the things you want to see. And with supply tapering off, it's going to have less competition. And then on the flip side, you have these these not well located, older vintage, needs work, busted value add deals that, I'm not sure we've kind of seen that floor yet. What's your take on this?
I would agree with that. Certainly you have that well-located Class A product, and particularly the deliveries from the last couple of years are very attractive product at this point. And if you're buying right now, you're buying at prices that are at least a little bit below replacement costs at this point. So they're very, very appealing at this point. And what is trading is that product. And we certainly saw the first movers in the last half of 2024. We saw a handful of portfolios that were $1 billion plus that were concentrated on this sort of product. So that's starting to happen, and that product will be on the top of everybody's list in 2025, and a lot of capital chasing those deals. When you're talking about the value add product, and particularly Class B minus to C product in less than ideal neighborhoods, what's the value on that product? I think we don't know, because in the last 2 years, almost none of that product is traded. So we'll have to see where we are. And so I think as we start moving product to the top end of the market, that will encourage, maybe by the time we get to the latter half of 2025, that we'll start seeing some of that C sort of product in not great locations begin to trade. I'll point out that's going to have to come from the local experts and owners in each market. And that syndication model where on a regional or national basis, you're coming in and picking up a lot of that product, that's not a real thing for the moment.
Yeah, absolutely. And that reminds me, Greg, I think one thing that you and I are here in Texas, and oftentimes I'll see these kind of national stories saying, hey, there's all this distress concentrated in Texas and Dallas and in Houston. But you kind of look at the profile of it, and it really is. I would kind of generally characterize as kind of out of state or newer syndication groups that bought to be in those MSAs, but in the worst locations and older product, and so it creates this kind of appearance of significant distress. And I guess there is in some ways, but it really is like an entirely different market from what's happening in these, I would say the more institutionally grade submarkets and assets.
And to me, it's also a factor of just how much of the existing product traded in 2021 and 2022. And so, the two poster markets for this are Phoenix and Austin, where so much of the inventory traded at top of the market prices. Yes, there's gonna be some distress in that bottom tier product in those spots. But that doesn't mean that there's distress in the marketplace overall. There's that little segment where we've got to work through some challenges. Yeah,
it's a very specific segment. So of course you're at IPA and being in that in broker world. I know everybody wants to see more deal flow, and of course on the sponsor side, everybody wants to see more deal flow here too. So what's the house take on deal flow in 2025? And just, we talked about this a little bit earlier, but we've heard a lot about. I think the second half of last year was all about all these BOVs, the broker opinions and values. There was so much more activity. Everybody was saying the same thing, like, "Hey, it's coming," and then it never really translated to a lot more deal volume. And much of what did trade last year, you alluded to this, were more of these larger portfolios that kind of spiked the numbers up a little bit. So what's the house view, and what would make that story change in 2025?
All right, so let's talk about the starting point of where we are on transaction volume. And I think the good comparison point is what was normal in 2014 to 2019. Before we hit that COVID period and then we had the spike. And if you want to compare it to 21, 22, it looks awful. If you compare it to what was normal in 2014 to 2019, trade volumes are down to some degree. If you're looking at the number of trades, it's down about 25%. If you're looking at the dollar volume, it's down a little bit less than that, maybe 20%, because what's traded has been the higher end sort of product. So we certainly think that we move up from here. As you talk to people in the institutional capital space now, what you're starting to hear creeping into the conversation is FOMO, that fear of missing out. And if I don't get deals done in 2025, then I'm not in position to take advantage of what's going to happen in 26 and 27 from everybody's perspective.
That's a legit concern.
So I think that the number of deals will move up considerably. And again, a lot of capital has already been raised and it's sitting there. And it's been sitting there for 2 or 3 years in some cases. And at some point, if you do not deploy that capital, you have to give it back. Yeah. So I think that's a motivator to get some deals done as well. So in 2025, are we going to get back to that 2014, 2019 norm? Maybe not quite, but I think it's going to move up meaningfully.
Yeah, no, I agree with you. And I think another thing, I had Justin Wheeler from Berkadia on recently, and he talked about the other thing being the fund of life issues for institutions that have to sell. You have some that on the front end you mentioned, they have to deploy that money or lose it. You also have owners who have to sell just because their window's expiring. They need to get capital back. So I think that could be a factor as well. And then, what are there other factors, Greg, you think that can really move volumes more? I mean, obviously everybody talks about rates. I mean, one of the things I get asked a lot is like, hey, like if rents get faster, will that get more volume? And it seems to me, it's like you need a lot of things to happen to really push a lot of volume. Otherwise, it's probably going to be more of a moderate pickup.
And I think the base case situation is that moderate pickup. I mean, there are, the economy has to cooperate completely, which maybe will happen and maybe won't. And you got to get some. Lots of people are willing to buy now, but somebody has to be willing to sell for the trade to actually occur. And so I think there are people who are okay with values at where they are, but it's down from certainly what was the peak. And so, if that's a loss, then that doesn't occur until you actually do the sale. So it's that question of how much product's really going to be available.
Yep, no, that's a good point. Sellers got to be willing to sell. So Greg, we talked earlier about markets. Let's come back to that for a moment. We talked about what markets kind of surprised us this past year. As you look to the next year or two, what markets or deal types do you think could be a surprise one way or the other?
Well, we've certainly alluded to what everybody's going to be chasing is that newer product in fast-growing metros and particularly in suburban locations. That's going to dominate sales activity over the next couple of years. I don't think there's any question there. I do wonder, are we ignoring the urban core maybe more than we should? Because we are going to be in a situation where, again, looking to 26, 27, we're not going to be delivering a lot of product overall, but what does come online will mostly be in the suburbs. And if we have a 2-year semi-break on deliveries in the suburbs, are we really talking it's 3-4 years in the urban core before we get a significant block of deliveries? So I think that there are probably some urban core locations and product that we need to be looking at. I don't think it's going to dominate. It's never either or. It's just how much emphasis do you put in each category. And I would be looking in urban core at this point.
Yeah, no, I think it's a fair take. What about markets?
So I look at our forecast numbers for 2025, I think what's going to be surprising to some people is how optimistic we are on the Florida markets.
Yep.
And in terms of rent growth potential, we actually have Orlando and Miami, South Florida area coming back and performing in line on rent growth with those Midwest and Northeast markets that have been at the top of the list for the last couple of years. The supply-demand balance gets righted in Florida a little bit more quickly than it does in Texas or the Carolinas and some other Sunbelt locations. So it's interesting to see on the investment environment, will insurance costs kill deals in Florida?
Yeah.
But in terms of overall market fundamentals, we think Florida is probably the comeback story in 2025.
Yeah, and to that point, I was just looking this morning at some data showing that Tampa is the first major Sunbelt market that went negative on rents and is now positive again, just barely. But Tampa is back slightly positive. And so I think that's a good take. A couple others, Greg, I'd throw out there is I think there's going to be some of these secondary Sunbelt markets, high growth markets that didn't see quite as much supply, but have great demand drivers. And I think we'll see some of those bounce back a little faster. Houston, Mark, we talked about earlier. I mean, I tell people all the time, I remember years ago, pre-COVID, I mean, we used to talk about all the challenges there, but that's a market that, because of all that, didn't build that much in this cycle. It was actually below average construction market in terms of percentage of inventory that was under construction. And that's a market that rents are now almost positive again. And so that's a market I think could, just because the expectations are so low, it could actually be probably one of the better performing Sunbelt markets, and actually national markets in 2025.
I think maybe the other one in the Sunbelt to keep an eye on is Nashville. And I mean, in terms of markets that still have a lot of product underway, that's true in Nashville, but it's so heavily concentrated
Yes.
in the urban core that I think suburban Nashville markets could be a real surprise over the next year or two.
It's so much harder to build in the suburbs of Nashville than it is downtown. So that's a real factor for sure. Then elsewhere in the country, Greg, I kind of think that everyone's talking about the Midwest right now for good reason. I'm a big fan of the Midwest, but I think what we're going to see there is more just the steadiness. Like those markets probably are going to level off in these where they are now, 3-4% growth.
I do think that's a good point, and I've seen some forecasts that have rent growth in those markets accelerating further. And I don't think that really...
That's not their profile.
I don't think that really happens. I think that, 4% is probably the ceiling in most Midwest markets. And I think you can do that again over the next couple of years. But some of these forecasts that I'm seeing that say 5 and 6% rent growth in the Midwest, that's probably not.
And I think Midwest operators are very happy with 3 to 4%.
Right, exactly.
And then they look at the coast. There's more supply kind of places like Seattle and DC. But generally, I think it'll be interesting. I mean, New York and Boston, the East Coast still seems to be better positioned than the West Coast. But I'm not sure we're going to see a big jump in some of these spots, but certainly maybe a modest improvement in the West Coast.
Yeah, I mean, of those coastal markets, we certainly still have Boston and DC at the top of the list in overall performance, but some good progress in some of the West markets that have been stragglers.
Yeah, absolutely. All right, Greg. Well, this has been fun. It's always good to talk shop, talk markets with you. So thanks for being here.
Awesome. Enjoyed the conversation.
Thanks, Greg.
And that's a wrap for episode 16 of the podcast. Big thanks again to Greg for coming on into the studio for today's conversation. Thank you to all of you for listening in, and we'll see you next time on The Rent Roll.